Today I would like to discuss the increasing usage of limited liability companies as the preferred form of business ownership, not only for small companies but also substantial companies that are not publicly held. Specifically, I want to talk to you about the advantages that limited liability companies pose in connection with an ultimate sale or merger of the company. Most of us are familiar with the advantages that an LLC poses in terms of current operations and ownership, namely there being only a single layer of tax and the flexibility that limited liability companies have in terms of multiple classes of ownership and governance. However, equally important, LLCs are an attractive business structure in terms of facilitating an ultimate sale of the company. To put it another way, if a company is formed with the ultimate intent that a few or even several years down the road, the company will be sold with the hope of generating a big payday for its owners, an LLC presents certain opportunities that will make an ultimate sale more easy and potentially more profitable. 1. For starters, when the LLC is sold, even if the purchaser buys LLC membership interests rather than assets, the purchaser can get a step-up in basis for tax purposes equal to the purchase price. In many acquisitions, this results in the creation of substantial amounts of goodwill and other assets that can be amortized for tax purposes, thereby creating tax benefits to the purchaser and accordingly increasing the value of the target company to the seller. The buyer can continue going forward to keep the acquired business in an LLC, generating only one level of tax, or have the flexibility to convert it into a corporation if it so chooses. These are real advantages to the buyer. Second, from the seller's point of view, the LLC company operating agreement can provide very flexible rules regarding the LLCs being sold or merged. In fact, a limited liability company agreement can give complete discretion to its governing board to implement a merger without any member vote at all. This allows LLCs with many owners but with a few substantial owners to concentrate control at the board level. Likewise, unless the LLC agreement provides otherwise, in a merger transaction, limited liability company members who disagree or wish to dissent from the merger do not have appraisal rights, as do dissenters in corporate mergers. Delaware limited liability company law also permits certain modifications for LLCs to the traditional corporate fiduciary duty, which lessens the litigation risks that managers and a majority of owners of LLCs are subject to in the context of making decisions regarding a merger or sale of the company. Finally, in terms of structure, Delaware and many other state LLC laws now provide for the same flexibility in structuring mergers of LLCs that has been available for years to corporations. Namely, Delaware LLCs can engage in forward mergers, reverse mergers, and triangular mergers, as well as convert by operation of law into a corporation. For these reasons, as investors, entrepreneurs, and other financial sponsors form new entities to undertake new businesses, to the extent that the ultimate liquidity or profit-making strategy involves a future sale of the company, one should give serious consideration to using an LLC.